I'm Frank Singer, and this is my Capstone presentation. Hi, John. Hi, Mary. Thank you both for coming in and meeting with me today. First off, I wanted to congratulate you, John, on the sale of your manufacturing company, and you, Mary, on your recent retirement from being a school teacher for the last 20 years. Also, I hope the two of you enjoyed your vacation in Europe. You've earned it based off of all those years of hard work. In preparation for this meeting, you provided me with your current goals and objectives, along with your risk tolerance. Before we dive in, I just wanted to confirm with the two of you that these have not changed. Okay, great, thank you. The agenda for this meeting then is to review your current financial health and dive into the different subject areas of a comprehensive financial plan. I will present recommendations within each subject area and, of course, answer any questions that you may have. Beginning with an overview of your current financial health, I have attached the statement of financial position, your balance sheet, a statement of cash flow, and some financial ratios compared against industry benchmarks to conduct your current financial health analysis. Looking at your balance sheet, the two of you have a total net worth of $13.7 million. Looking at your statement of cash flows, you have a net disposable income of $1.1 million. Because of your significant net worth and strong disposable income, I'm happy to say that the two of you are in a good financial health and have the flexibility to reach your financial goals and objectives. The two of you are currently in the spending phase of your life cycle plan and have the assets and cash inflows to support this phase. I conducted a few financial ratios to further measure your financial position against industry benchmarks. First, I calculated your current ratio, which measures your ability to cover short-term liabilities by taking current assets and dividing them by your current liabilities. Your current ratio is 49, which is significantly higher than the benchmark ratio of 1. A current ratio this high means that you have excess cash on hand and should consider putting your cash balances towards more capital efficient uses. I also reviewed your monthly housing cost ratio, which divides your monthly housing cost by your monthly income. This ratio is suggested to be under 28%. I calculated your ratio to be 4.7%, well below the 28% benchmark threshold, indicating a financial strength for your position. I examined your broad housing and other debts ratio as well, which divides your monthly housing costs and other debts by your monthly income. This ratio is suggested to be below the 36% threshold. I calculated your ratio to be 11.8%, again, well below the industry benchmark and indicating a financial strength for the two of you. I also compared your current cash and cash equivalents to your total expenses and found that your cash and cash equivalents could cover 1.8 years or 20 months of your total expenses. I typically suggest clients to have an emergency fund of 3 to 6 months, making your emergency fund of 20 months significantly higher. Like mentioned when reviewing your current ratio, I suggest putting forth some of your large cash buildup towards reaching your financial goals and objectives instead of sitting in bank accounts, which we will talk about in your recommendations now. So looking at your recommendations, I do have some recommendations based off of the balance sheet and the statement of cash flow. The first item of recommendation has to do with John's certificate of deposits. CDs are only FDIC insured up to $250,000 per person at a single bank, indicating that $550,000 of John's $800,000 of CDs are not FDIC insured. I suggest that upon maturity of these CDs, John takes the $550,000 of non-FDIC insured assets and invests the funds into a market vehicle that matches his high risk tolerance, such as an S&P 500 index fund or an exchange traded fund. I also suggest that the two of you invest some of your large cash balance into these diversified investment options to better utilize your cash and fight purchasing power risk from inflation. Since a well-diversified portfolio is one of your goals, I believe this recommendation is advantageous for you. A second suggestion when reviewing your financial health would be to drop principal mortgage insurance on your primary residence. The primary residence does not have any remaining principal payments, therefore, principal mortgage insurance is an unnecessary expense. A third suggestion arose when reviewing your vacation home. Currently, your vacation home has a fair market value of $750,000 with only 52 remaining mortgage payments, or $52,908.36 at a 5% fixed rate. Due to the fact that you have strong financial flexibility and are in an increased cash state, I would suggest paying off this amount in full in 2024 to remove future future mortgage payments, expenses from your vacation home. Lastly, a recommendation when reviewing your total expenses within your statement of cash flow. In 2023, you spent $43,500 on vacations and entertainment, dining out, and fun money. These are discretionary expenses that can create additional financial strengths and flexibility if you were to reduce them. I do, however, know that you've both worked very hard and want to spend some of your hard-earned money in your current spending life cycle phase, so this is all up to you, and if you do not wish to decline this expense, I completely understand. If there are no questions on your current financial health section, we can dive into a review of your risk management and insurance coverage. So looking at your current insurance policies, I want to start with the primary homeowner's insurance policy. This was identified as an area of weakness in your insurance coverage. A strong homeowner's insurance policy should cover 80% of the fair market value of your home to avoid being underinsured. Currently, your primary homeowner's insurance only covers 44% of the fair market value of your home. Looking at the vacation homeowner's insurance policy, this too was identified as a similar area of weakness in your insurance coverage, as your current policy only covers 61%, which is below the 80% threshold. A second weakness in the vacation home policy is that it is an HO3 named perils policy. For example, if there is flood damage, which vacation homes are typically subject to, the current policy would not cover any of these expenses from flood repairs, and you, John and Mary, would have to solely pay for these expenses. Reviewing your personal auto policy, you do have adequate coverage here. The policy covers $200,000 in bodily injury per person, $600,000 per accident, and $15,000 worth of property damage. Your current policy will pay $14,650 on a $15,000 claim, but any claims above $15,000 will result in a shortfall needed to be paid out of pocket. When reviewing your insurance coverage, it stood out that you do not have any insurance on your 2019 boat that has a fair market value of $95,000. A third weakness that needs to be addressed from a risk management perspective. Shifting to your current health insurance policy, I see that you purchased Medicare Part A, B, and D. With Medicare Part A, B, and D, you have insurance coverage for hospital stays, doctor's visits and outpatient care, and prescription drugs. An area of weakness in terms of your current Medicare coverage is not having any dental or vision coverage. Reviewing each of your separate life insurance policies, both policies do have adequate coverage, as you both have significant retirement income covered under the current life insurance policies in the case of an untimely death. Lastly, we reviewed your need for long-term care insurance, which is one of your stated goals in our prior information gathering meeting. Based off of your current ages and significant asset size, in my opinion, purchasing a long-term care insurance policy is within your best interest. This leads us to my current recommendations after reviewing your risk management and insurance coverage. As stated in the overview, your primary homeowner's insurance policy does not cover 80% of the fair market value of your home. To achieve the 80% coverage, I recommend increasing your primary homeowner's insurance coverage by $320,000. Building off that increase in coverage, I also suggest you increase your vacation home coverage by $140,000 to also have 80% coverage on this residence. Also on the vacation home, I suggest purchasing a separate insurance policy for floods and natural disaster recovery to protect the vacation home against any unforeseen circumstances. Since you currently do not have an insurance policy on your 2019 boat, I suggest you explore options to have this personal use asset covered by an insurance policy. Perhaps you could speak to the insurance agent who recommended the two of you to me about obtaining this coverage. Based off your current medical insurance that consists of Medicare Part A, B, and D, I suggest you purchase a supplemental Medigap insurance policy. Purchasing a Medigap policy will extend your medical insurance coverage to areas like dental and vision, filling in some of the shortfalls of your current coverage. Analyzing one of your goals, which is to look at purchasing long-term care insurance, I do recommend you purchase a comprehensive long-term care policy. Purchasing a comprehensive long-term care policy will allow the two of you to share in each other's benefits. Having a long-term care insurance policy provides flexibility on where you can receive care, such as nursing and retirement homes. Selecting a comprehensive policy allows Benefits to be paid for 3 years or up to $360,000, whichever comes first. The annual premiums will be $6,400 for John and $5,330 for Mary. If the two of you were to itemize your income taxes in 2023, however, the premiums will be significantly lowered by the allowed medical deductions of $5,960 for John and $4,770 for Mary. Factoring in the medical deductions, the premium amounts for a comprehensive long-term care insurance policy will be $440 for John and $560 for Mary. Given how affordable the premiums are and how much risk the long-term care insurance policy will be offsetting, I believe it is within your best interest to purchase this policy. Lastly, I do recommend you review implementing an umbrella insurance policy that goes above and beyond your existing insurance policies as an additional layer of security. A review of an umbrella insurance policy is being recommended to you, John and Mary, because you are high net worth individuals. Consult your current insurance providers on the possibility of an umbrella policy, as purchasing it from an existing provider will likely be less expensive. That concludes everything I wanted to address from a risk management insurance coverage section. So if there are no questions, we can look at your investment planning. So in your investment planning, starting with the non-qualified stock portfolio, there was a fair market value today of $940,000 with an original cost basis of $960,000, which calculates a holding period return of negative 2.1%. The negative investment return of this portfolio is being driven entirely by stock A, which has been a very poor performing, above market risk holding. The asset allocation of the stock portfolio has a 58.5% weighting to stock D, which is weak from a diversification perspective. Having a diversified portfolio that meets your investment needs and expectations is one of your listed goals for this meeting. Currently, the stock portfolio is not well diversified, as it only has 4 individual stocks and is not meeting your investment expectations and goals with negative investment return. Looking at your mutual fund portfolio, there is a fair market value today of $2,907,682 with an original cost basis of $2 million, which calculates a holding period return of 45.4%. The mutual fund portfolio is well diversified, with large cost bases across balanced, growth, bond, and international funds. Reviewing the Sharpe ratio of the combined non-qualified accounts versus the Sharpe ratio of the market, the non-qualified accounts are performing on a total risk or underperforming on a total risk adjusted basis. This means that if allocations were made to a general market portfolio instead of the current non-qualified investment accounts, you would be receiving a higher return based on the current risk you were invested in. This is a current area of weakness within your investment planning. Reviewing John's 401k account, there's a fair market value today of $1,054,540 with pre-tax contributions totaling $605,000. Which calculates a holding period return of 74.3%. John's 401k is invested only in large cap blend stocks, which I would normally note as a diversification risk. However, in John's case, this matches his above average ability and willingness to take risk. Mary's 403b account has a fair market value today of $545,000 with pre-tax contributions totaling $120,000, which calculates a holding period return of 354.2%. Mary's 403b account has been well diversified since she began contributing to the account, being invested in target date fund option, but the current asset allocation of the target date fund does not match her risk tolerance. Target date funds become much more weighted to low risk, fixed income holdings as they get closer to the desired retirement year. For recommendations on your current investment planning, I recommend that you sell stock A in the non-qualified stock portfolio. Stock A has been a very meaningful detractor on your overall investment performance with a strong underperformance. Selling stock A will not only remove a poor holding from your portfolio, but is also advantageous from a tax perspective. Stock A has an unrealized loss of $218,000. By selling stock A now, you can implement a tax loss harvesting strategy that utilizes $3,000 of the unrealized loss of stock A in the current and subsequent years that can help offset some of the capital gain taxes on unrealized investment gains from your other holdings. One of your stated goals is to reduce your personal income taxes in the current year, and this tax loss harvesting strategy of selling stock A is in line with that goal. I also recommend that within the mutual fund, you sell the current bond fund holdings and invest the proceeds into a municipal bond fund. Investing in a municipal bond fund is advantageous from a tax perspective as well, as municipal bond funds are tax exempt from a federal tax standpoint and exempt from a state tax standpoint if the bonds are issued in your home state. Switching to a municipal bond fund, therefore, creates a tax savings across the life of the mutual fund portfolio. I recommend that Mary adds additional investments to her 403b account. Mary's allocation in her 403b account has been shifted to much more conservative investments focused on the preservation of capital as she is coming up on the target date retirement age of the fund. I recommend that Mary add some large cap equity holdings or a large cap index fund to her 403b account to better align with her high risk tolerance and help mitigate inflation purchasing power and purchasing power risk as she is currently in her spending life cycle phase. If Mary prefers a more hands-off approach to her investing and likes the target date fund options, I recommend that she invest in a more aggressive target date fund option such as a 2050 fund. Lastly, I recommend that upon receiving funds from the installment sale payments of John's business, you consider building a diversified stock portfolio with securities from all industries and sectors that matches your high risk tolerance. Along with a new diversified stock portfolio, you should consider buying put or call options against the individual stocks that you hold to limit downside risk and capture. Having these options in place works towards your investment objective of preserving capital. With those recommendations made, that concludes our investment planning review, and we can now look at your current retirement planning section. Overall, after conducting a retirement needs analysis for the two of you, John and Mary, you are currently in a strong financial position and meeting your retirement goals. The two of you mentioned you are not concerned about saving for retirement, and based off of your considerable asset size and current 401k and 403b positions, I would agree that this should not be an area of concern. Shown in the attached assumptions, there is an inflation rate of 2.25% that will impact the value of your retirement assets. Starting with John's 401k, I calculated the inflation-adjusted return to be 6.26%. For Mary's 403b, I calculated the inflation-adjusted return to be 6.26%. Excuse me, that was John's. For Mary's 403b, I calculated the inflation-adjusted return to be 4.84%. These returns were calculated to show that even when accounting for inflation, you each have an adequate adjusted return on your investment accounts that should not be minimized by purchasing power risk. If the inflation rate increases above 2.25%, this could lead to a situation of lower returns and a loss of purchasing power. The effect of inflation on your current retirement assets should continuously be reviewed as long with the potential longevity risk inflation has. Also, when reviewing John's 401k account, it is important to note that he will have to begin withdrawing the required minimum distributions from this account when he turns 72. Required minimum distributions are calculated by dividing the retirement account's prior year-end fair market value by a life expectancy factor published by the IRS. If John fails to make these required minimum distributions, he will be subject to a 25% penalty. One thing you mentioned for me to evaluate was growing John's 401k tax-free and distributing the maximum amount left in this account to Edward and Brent. 401k and 403b accounts are tax-deferred, meaning pre-tax money is contributed to these accounts, but when the distributions are made, they will be taxed at your current income tax rate. Currently, you are in the highest marginal tax rate of 37% because of the installment sale of John's business. Therefore, the best way to grow John's 401k account tax-free is to implement a series of Roth IRA conversions over a series of years. Although it is not listed as one of your concerns, the same will apply for Mary's 403b account. This leads us into my recommendations for your current retirement planning. I recommend that John, with his 401k, and Mary, with her 403b, implement a series of Roth IRA conversions after the installment sale of John's business is completed in 8 years. I recommend these conversions do not begin until after the installment sale to minimize the income tax liability on the conversions. You will have to pay taxes on the amount being converted from your employer-sponsored retirement accounts to the Roth IRAs which is not attractive until after the sale of John's business because of the 37% marginal tax bracket. Once the series of conversions are final, any future gains and distributions from the Roth IRAs will be tax-free, assuming that distributions are not made for at least 5 years after the conversion. Having tax-free distributions from the Roth IRAs will help you achieve your goal of growing John's 401k account tax-free and leaving the maximum amount of funds left to your children upon your deaths. Lastly, I propose that the two of you investigate making contributions to a non-deductible IRA this year as you wait for the installment sale of John's business to be final. Contributing to a non-deductible IRA creates an additional retirement savings vehicle that can be left to your two sons upon your death. John can contribute up to $7,500 to a non-deductible IRA for the 2023 year because he has an earned income of $11,000. The maximum amount you can contribute to an IRA in 2023 is $6,500, but since John is over the age of 50, he can contribute an additional $1,000 in catch-up contributions. Mary, because she does not have any earned income for 2023, can make a spousal contribution to a non-deductible IRA. Mary can contribute $3,500 to a non-deductible IRA if John contributes the $7,500 maximum amount. Together, you cannot contribute more than your combined $11,000 earned income. When John turns 72, as stated earlier, he will have to begin taking required minimum distributions from this recommended non-deductible IRA. Something to consider is taking these RMDs in the form of qualified charitable distributions, as they are tax-free and offer you the chance to donate to a cause you are passionate about. If John decides to take the required minimum distributions as qualified charitable distributions, he will not be taxed on the earnings from his contributions. This concludes your retirement planning section, and we will now review your taxes. Reducing personal income taxes was one of your main goals in coming into this meeting, which has made income tax planning one of my main focus areas in preparation. Starting with the installment sale of John's manufacturing business, the first thing I did was calculate the tax implications of the 25% down payment. The realized and recognized long-term capital gain on the $1 million down payment was calculated to be $831,250. I came up with this calculated amount after subtracting out the $168,750 return of basis from the $1 million down payment, as a return of basis is not taxed. The $831,250 will be taxed at the highest long-term capital gain rate of 20% in 2023. Reviewing the first installment payment on the sale of John's business, I calculated a realized and recognized long-term capital gain to be $22,085. The first installment payment was calculated to be $36,567.83, and to determine the taxable amount on this payment, we had to subtract out interest income, which was $9,999, and a return of basis, which was $4,483. The $22,085 will be taxed at the highest long-term capital gain rate of 20% too, as this payment will be received in 2023. Choosing to sell John's business in the form of installment notes was advantageous from a tax savings perspective. The installment sale helps spread out capital gains and interest income over multiple years, which helps to reduce the amount of taxes you will pay on the sale of John's business. If instead you elected to receive the sale of the business in full without an installment note, you would have had to additionally consider the tax consequences of a Section 1245 gain, which is taxed at ordinary income rates of 37%, Section 2050 gains, and Section 1231 gains. Reviewing the income tax planning of your investments, your investment interest income is currently being taxed at the highest marginal tax rate of 37%. Since your investment interest income is taxed at the highest rates, selling stock A, as mentioned in the investment planning section, within the non-qualified stock portfolio, and selling the current bond fund holdings within the mutual fund portfolio, and reinvesting into a tax-free municipal bond fund, would reduce personal income taxes in the current and subsequent years. One of the questions in preparation for this meeting was from John was what would the taxes would be if he sold his 1918 mint 24-cent inverted Jenny stamp collection. Assuming John sold the Jenny stamp in 10 years for $2,550,000 and there was a 15% commission on this sale, the realized and recognized gain would be $1,667,500, taxed at a rate of 31.8% for a federal tax liability of $530,265. The $530,265 in federal tax liability was calculated through a few steps. The first being subtracting out the 15% commission amount of $382,500 to get an adjusted sales price of $2,167,500. John's basis in the Jenny stamp of $500,000 was then subtracted from the adjusted sales price to determine the realized and recognized gain amount of $1,667,500. When John's dad passed away, the Jenny stamp was bequeathed to John's mother, with the basis being $500,000. The original fair market value of $75,000 was stepped up to $500,000 on the date of John's father's death. When John inherited the Jenny stamp from his mother, his basis became the $500,000 stepped up value and not the fair market value of $725,000 when the stamp was gifted to John. The 31.8% tax rate that is multiplied by the realized and recognized gain was determined by a 28% collectibles tax plus the net investment income tax rate of 3.8%. Lastly, you provided me with a list of itemized deductions totaling $127,060 and asked me to determine the amount that is deductible in arriving at taxable income. Based off the list of deductions you provided, the calculated deductible amount is $25,500. The real estate taxes on your principal residence and vacation home cannot be included in arriving at the itemized deduction amount. Looking at the state income taxes of $90,000, as a couple, you can deduct $10,000 from this amount based off the Tax Cut and Jobs Act of 2017. This act capped state and local income and real estate property tax, i.e. SALT deductions, to $10,000 per couple. The Tax Cut and Jobs Act of 2017 significantly raised the standard deduction for married couples filing jointly, but limits the number of deductions that can be itemized. The entire interest on your vacation home of $2,000 and the entire $13,500 in charitable deductions can be included in arriving at the number of itemized deductions. Since your itemized deductions only add up to $25,500, I advise the two of you to take the standard deduction amount of $27,700 for married couples filing jointly in 2023. Choosing to elect the standard deduction will reduce your taxable income amount by $2,200 more than if you itemize your deductions. Diving into the tax planning recommendations then, first, as recommended in the investment planning section, you should sell Stock A in the non-qualified stock portfolio and sell the current bond fund holdings in your mutual fund portfolio and reinvest the proceeds into tax-free municipal bonds. Selling Stock A in your current bond fund holdings will limit your personal income taxes as your investment income is currently being taxed at the highest marginal rate of 37%. Next, I recommend that you continue with the installment sale note structure for John's business across his 8-year life. Again, doing so will limit the amount of personal income taxes you will pay each year on the sale of John's business. Concerning the sale of John's inverted Jenny stamp collection, I recommend that you keep up with your current plan of not selling the collection for 10 years or until after the installment sale of John's business is final in 8 years. For your 2023 tax year deduction, I recommend you elect the standard deduction amount of $27,700 instead of your calculated itemized deduction amount of $25,500. As stated in the review, doing so will reduce your taxable income by $2,200 more than if you itemize. Lastly, I recommend that you consider renting out John's vacation home for a week or 2 weeks to generate additional tax-free income. Any rental income received from fewer than 15 days is tax-free. Of course, there is risk to renting John's vacation home, but doing so for less than 15 days can generate additional tax-free income if you desire. We will now discuss in your last area of focus, estate planning. Reducing any estate tax liability and ensuring all essential estate planning documents are in order was one of your main goals coming into this meeting. Starting off, you have a will, John. You have a will in place with Mary as the primary named beneficiary. Mary, you have a will that is in place that has John as the named primary beneficiary. In both your wills, Edward and Brent are the named second beneficiaries per stirpus. In terms of life insurance policies, both of you hold life insurance policies in your own names, payable to one another as beneficiaries. Edward and Brent are contingent beneficiaries, receiving 50% each of both of your life insurance policies. John, you have a non-qualified single premium deferred annuity with Mary as the primary beneficiary and Edward and Brent as contingent beneficiaries. A major weakness that was identified in your estate planning analysis is that neither of you, John and Mary, have essential estate planning documents in place. Documents such as durable power of attorney and healthcare proxies are essential estate planning documents that are needed if either of you were to become incapacitated. Reviewing your current estates, neither of you will be subject to estate taxes this year if you were to pass away. However, both John and Mary, your estates will be subject to excessive probate fees based off the current titling of many of your assets. John's current estate will be subject to probate costs of roughly $9.9 million, and Mary's current estate will be subject to probate costs of $565,000. Probate is a legal process in which the assets of a deceased person are publicly reviewed in probate court to determine the division and distribution of the deceased person's assets to beneficiaries. Based off your current estate planning review, you are not achieving your goal of reducing estate tax liabilities because of the excessive probate costs, and you do not have all essential estate planning documents in place with a durable power of attorney and healthcare proxy documents missing, which leads me to my recommendations. First and foremost, the two of you should schedule an appointment with an estate planning attorney to implement a power of attorney, healthcare proxies, and other advanced directives to achieve your goal of ensuring all estate planning documents are in order. During this meeting, I also recommend that the two of you review your living will and life insurance policies with your estate planning attorney to ensure they are in good order and accurately reflect your financial goals. Looking at John's estate, I recommend that John, with the help from the estate planning attorney, changes the titles of his certificates of deposits, his non-qualified stock mutual fund portfolio, vacation home, 2019 boat, and 2019 Chevy to SUV to tenancy by the entirety. Making these titling changes would allow the assets to automatically transfer to Mary, the surviving spouse, if John died first. Having these assets under the title of tenancy by the entirety allows them to skip the expensive probate court process and avoid probate fees. I recommend that Mary also changes the titling of her 2019 Chevy automobile to tenancy by the entirety to avoid probate and have the assets pass directly to John if she were to pass first. For John's 401k account and Mary's 403b account, I recommend the beneficiary designations are changed from both John and Mary from your estates to a transfer on death designation with the other spouse listed as the primary beneficiary. Transfer on death designations will allow the assets in John's 401k account and Mary's 403b account to pass to the surviving spouse without having to go through the public probate process. Changing the beneficiaries of these retirement accounts to each other, along with changing the titling of the assets mentioned above to tenancy by the entirety, will significantly lower John and Mary's probate estates portion and limit their estate tax liability. Another recommendation is to discuss the possibility of placing the installment sale of John's business and John's 1918 inverted Jenny stamp collection into a revocable trust. Having these large assets in a revocable trust gives John the ability to control the assets throughout his life and removes these assets from his estate, meaning they will no longer pass through probate. John will have to work with an estate planning attorney to establish who the trustee of the revocable trust will be, and the trust will become irrevocable upon his death unless he terminates the trust prior to his death. Lastly, I recommend that you, John and Mary, ask your estate planning attorney about establishing a charitable gifting trust because of your high net worth. Establishing a charitable gifting trust would allow you to gift to a cause you are passionate about and will allow you to take charitable deductions on your federal income tax. Now that we've reviewed each section of your comprehensive financial plan, I would like to pause and see if you have any questions on the material I put together. Okay. So I do have some action items and next steps now that we can discuss. First, The two of you need to meet with an estate planning attorney to complete your goal of ensuring all essential estate planning documents are in order. If you accept this recommendation, I can give you some of the name of local estate planning attorneys to begin the conversations with. You can fund the meeting with an estate planning attorney with the large cash balances you have in your checking and saving accounts. The date of completion for this item is immediate. Second, I suggest changing the beneficiary designations of John's 401k account and Mary's 403b account from their estate to a transfer on death designation with the other spouse listed as the primary beneficiary. If you accept this recommendation, you should bring this up as another item when you meet with your estate planning attorney. Again, you can fund this meeting with your checking and savings accounts. The date of completion for this item is also immediate. Third, I suggest meeting with your current insurance provider on your primary residence and increase your coverage by $320,000. Currently, your primary residence is underinsured. If you accept this recommendation, I suggest emailing or calling your insurance provider within the next week to discuss an increase in coverage. The date of completion for this item is 30 to 60 days. Fourth, sell Stock A and the non-qualified stock portfolio. Stock A currently has an unrealized loss of $218,000. $3,000 of this unrealized loss can be used in this year and in future years to offset some of your long-term capital gains and reduce your personal income taxes. If you accept this recommendation, we can implement a tax harvesting strategy in our next meeting. The date of completion for this item is 30 to 60 days. Fifth, purchase shares of a large cap stock index or switch from a 2025 target date fund to a more aggressive 2050 target date fund from Mary's 403b account to match her high risk tolerance. If you accept this recommendation, we can begin working with your current 403 provider, such as Fidelity or Vanguard, to get Mary into a more aggressive investment portfolio diversification that matches her high risk tolerance. We will sell some of the current holdings in Mary's current 2025 target date fund and reinvest the proceeds into these more aggressive holdings. The date of completion for this item is 30 to 60 days. Sixth, sell the current bond fund holdings within the mutual fund portfolio and invest the proceeds into tax-free municipal bonds. If you accept this recommendation, we can begin talking about the steps to sell your current bond fund holdings and invest in tax-free municipal bonds in our next meeting as well. The date of completion for this item is 90 to 120 days. Lastly, I suggest that you purchase a long-term care insurance comprehensive policy. If you accept this recommendation, we can discuss further how a long-term care policy will allow the two of you to share in each other's benefits and the flexibility it offers on where you can receive care. The current premiums are small, $440 for John, $560 for Mary. This can be funded from your checking account. Since the two of you are in excellent health, this can be a midterm goal with the date of completion within a year. Do you have any questions on these action items? Okay, well, great. Thank you for your time, John and Mary, and I hope you found this meeting to be productive. I look forward to continuing this relationship and doing my part to help you achieve your financial goals and objectives. In terms of next steps, I would like to connect virtually next week, whether by phone or Teams meeting, to ensure that you have an appointment scheduled with your estate planning attorney and answer any questions you may have then. As always, if you have any questions or if something comes up, please feel free to call me. I am here as a resource for you. Thank you.